Hello and welcome to the Commodities Institute podcast. I'm Emily Costa and today is February 17th, 2026. As always, I'm glad you're spending part of your day with me because the commodity markets right now are anything but quiet. In fact, they are telling us a remarkably connected story about energy security, food resilience, and how geopolitics keeps rewriting trade flows in real time. For the first time, copper has overtaken iron ore as the biggest earnings driver for BHP Group. That is not just a headline, it is a signal. Copper demand, driven by artificial intelligence data centers and electrification, is now strong enough to reshape balance sheets at the world's largest miners. In the last half year alone, copper contributed more than half of BHP's operating earnings, helped by a sharp jump in realized prices. Iron ore, long the backbone of the sector, is still massive, but rising supply and higher costs are starting to squeeze margins. When a company as conservative as BHP says it feels no urgency to chase acquisitions because organic copper growth is strong enough, that tells you how confident they are about long-term demand. Staying with metals for a moment, Liberia is quietly becoming a much bigger iron ore story. The country expects output to roughly triple this year, as expansion projects ramp up and new producers enter the market. For a small economy, that kind of growth can be transformative, especially as the government moves toward equity participation in mining projects rather than relying only on royalties. It is part of a broader trend across Africa, where governments want a larger share of the upside during commodity booms, and it will be something investors will need to factor in more seriously going forward. Now, let's pivot to oil because flows are shifting in ways that underline how sanctions and geopolitics continue to reshape global trade. China is on track to import a record volume of Russian crude this month, overtaking India as Moscow's biggest seaborne buyer. Deep discounts are doing the heavy lifting here. Russian barrels are trading well below Brent, making them extremely attractive to Chinese independent refiners, often known as teapots. What's especially interesting is that concerns over potential United States action against Iran have made Russian supplies look paradoxically more reliable. When geopolitical risk rises, buyers do not just look at price, they look at perceived continuity of supply. At the same time, Europe is dealing with a very different kind of oil stress. Flows through the Druzhba pipeline into Hungary and Slovakia have been halted, triggering emergency responses. Hungary has already moved to release strategic crude reserves and is seeking alternative routes via Croatia's Adria pipeline. This situation highlights how fragile pipeline-dependent supply chains can be during conflict and how exemptions to sanctions still leave countries exposed to physical disruptions. Energy security, once again, is not an abstract policy concept. It is about whether refineries get feedstock next week. From oil, let's move into agriculture, where weather has been both a blessing and a complication. Morocco is expecting its cereals harvest to roughly double this season thanks to abundant winter rains. After years of drought stress, reservoirs are refilling and planted area has expanded significantly. That is great news for domestic supply and food security. But heavy storms have also disrupted port operations, delaying wheat imports and driving up costs for traders who are paying tens of thousands of dollars per day for ships stuck offshore. This is a perfect example of how logistics can matter just as much as production when it comes to food markets. In West Africa, the story is very different. Cocoa stocks are piling up in Ivory Coast as global prices slump and exporters resist paying the government-mandated farm gate price. For farmers, this creates a cash flow crisis. They need to sell beans to pay debts and prepare for the next crop, but buyers are pushing prices lower than regulations allow. The government has stepped in to purchase some of the unsold cocoa, but the episode exposes a deeper tension between price controls and volatile global demand. When consumption slows, even the world's largest producer feels the strain almost immediately. Let's talk about carbon and power because gas is quietly reasserting itself as a transition fuel. In Greece, a consortium led by Chevron has signed agreements to explore for natural gas offshore, expanding the country's role as a potential gateway for United States liquefied natural gas into Europe. This fits neatly into Europe's broader strategy to reduce dependence on Russian energy while balancing the intermittency of renewables. Gas is not going away anytime soon, especially when grid stability is on the line. Further south in South Africa, a major gas-fired power and liquefied natural gas import project is taking shape at Durban's port, backed by global trader Vitol. With coal still dominating the power mix and electricity shortages persistent, gas is being positioned as a pragmatic bridge. What stands out here is the scale. A multi-billion-dollar investment signals confidence that gas demand in southern Africa will grow steadily over the next decade, both for power and for industrial use. Before we wrap up, I want to touch briefly on dry freight and critical minerals, because both are reminders that supply chains are under pressure in unexpected places. Russian wheat exports are facing weather-related shipping disruptions, pushing prices higher even as overall export volumes remain substantial. Storms and ice may sound mundane, but they can tighten markets just as effectively as policy decisions. And in Australia, the first shipment of antimony from a domestic processing plant marks a small but significant step toward diversifying supply of critical minerals used in defence, semiconductors, and energy storage. In a world increasingly focused on supply chain resilience, these incremental developments add up. So when you zoom out, today's commodity landscape tells a single, interconnected story. Energy security is driving oil and gas decisions. Electrification and technology are reshaping metals demand. Weather extremes are rewriting agricultural outcomes. And governments everywhere are becoming more hands-on, whether through strategic reserves, equity stakes, or price controls. That's all for today's episode of the Commodities Institute podcast. If you found this episode valuable, be sure to subscribe, share, and leave a review.